Have you ever thought to yourself, well, my spouse doesn't have a job, so they can't save for retirement in an IRA? Well, if that sounds familiar, you're definitely not alone, but you could be leaving a massive amount of tax-free wealth on the table. So today, let's dive into one of the most powerful and frankly most overlooked strategies for married couples. So here's what we're going to cover in the next few minutes. We're going to bust a huge myth about IRAs, break down exactly how this strategy works, walk through a real-world example so you can see it in action, show you the incredible long-term payoff, and then give you a clear step-by-step action plan you can use like today. All right, let's kick things off by tackling a really common and really costly misconception head-on. So here's the big question. Let's say your spouse is a caregiver, a stay-at-home parent, or maybe they're just between careers. For the entire year, they have zero W-2 income. Can they still put money into their own Roth IRA? What do you think? The answer is a huge, resounding yes. A spouse with absolutely zero earned income can contribute the maximum amount to their own Roth IRA. I'm telling you, this is a total game changer for building your family's wealth. So let's get into exactly how it's done. So, how is this even possible, right? Well, the whole mechanism is called a Spousal IRA. And believe me, the rules are surprisingly simple. Now, a spousal IRA isn't some weird, special type of account. Nope, it's just a regular IRA. In our case, we're talking about a Roth IRA that uses a really clever rule. It lets the working spouse's income qualify the non-working spouse for their own contributions. It's a completely legal and, honestly, a brilliant way to keep your family's retirement goals right on track. There are really only three main rules you gotta follow. First, you have to be married and file your taxes jointly. That's a big one. Second, the household needs enough earned income to cover contributions for both of you. So for example, if you both want to put in $7,000, the working spouse needs to have earned at least $14,000. Easy enough. And third, and this is super important, these are separate accounts. And I really want to hammer this point home. This is not a joint Roth IRA. Those don't even exist. The account is opened in the non-working spouse's name, and they, and only they, have 100% ownership and control over it. Forever. Period. All right, let's look at the numbers for 2025. As long as your household's income, that's your modified adjusted gross income or MAGI, is under $236,000, you're good to go. For each spouse under 50, you can put in up to $7,000. And if you're 50 or older, you get that nice catch-up, bringing your limit to $8,000 each. Okay, theory's one thing, but let's make this crystal clear. Let's walk through a real-world example to see this thing in action. So let's meet Mike and Sarah. They're both 48. Mike is a teacher, and he earns $75,000 a year. Sarah is a full-time caregiver for her mom, so she has zero official income. And super important, they file their taxes jointly, so they've already checked off rule number 1. So the question is, can they both contribute? You bet they can. Mike's $75,000 is more than enough to cover contributions for both of them. So Mike puts his $7,000 into his own Roth IRA, and then he also contributes another $7,000 into Sarah's separate spousal Roth IRA. And just like that, boom, they've doubled their household's tax-free savings for the year, putting away a cool $14,000. Doubling your savings for 1 year? That's awesome. But the real magic, the part that should get you really excited, is seeing what this does over the long haul. Just look at this difference. It's staggering. If it's just Mike saving that $7,000 a year, after 20 years, assuming a pretty standard 7% return, he'd have around $306,000. Not bad. But by using the spousal strategy and putting away $14,000 a year together, their combined nest egg skyrockets to $612,000. They have literally dollar for dollar doubled their tax-free retirement wealth. Just let that number sink in for a second. Over $500,000. And every single penny of that is completely tax-free in retirement, all of it made possible just by knowing one simple rule that, honestly, most people just don't know about. And the benefits go way beyond just that big number at the end. With a Roth IRA, you don't have what are called required minimum distributions during the original owner's lifetime. What that means is the government can't force Sarah to start taking money out at a certain age. Her money can just keep growing tax-free well into her 80s or 90s. And eventually, it can be passed on to their kids as a tax-free inheritance. It's an unbelievably powerful estate planning tool. Now, you could do this with a traditional IRA, but honestly, for most people, the Roth is the way to go. Why? Well, the working spouse, like Mike, probably already has a 401k at work to get those upfront tax deductions. The Roth Spousal IRA gives the family something different: tax diversification, the awesome flexibility to pull out your contributions anytime without penalty, and of course, that beautiful tax-free growth for life. Okay, so you see the power here. You get it? Now, let's switch gears and talk about how you can actually put this into action right now, because there's a really special window of opportunity that you absolutely need to know about. Okay, listen up, because this is important. Every single year, from January 1st to the tax deadline, which is usually April 15th, you have this unique chance to essentially do a double contribution. So here's how this catch-up strategy works. Let's imagine a couple, and they're both over 50. Let's say they didn't contribute at all for 2024. Well, between January and April 15th of 2025, they can make their full $8,000 contribution for the prior year, 2024, and they can also make their full $8,000 contribution for the current year, 2025. You're funding 2 years at once. You do the math on that, that means a couple over 50 could literally turbocharge their retirement savings by pumping a total of $32,000 into their Roth IRAs in just a few short months. I mean, what an incredible way to get ahead. All right, here is your action plan. It's 4 simple steps. 1, if your spouse qualifies, go open a spousal Roth IRA in their name today. 2, automate it. Set up those automatic monthly transfers so you don't even have to think about it. It just happens. 3, seize that opportunity. Fund last year's contribution before that April 15th deadline. And finally, number 4, just double check, triple check that the account is in your spouse's name and their name only. So, we've just walked through how you can potentially double your family's tax-free wealth. It's a huge deal, and it really makes you wonder, doesn't it? If a strategy this powerful was basically hiding in plain sight, what other game-changing financial secrets are you missing out on? Well, you're going to want to stick around, because in our very next explainer, we are diving deep into the Saver's Credit. This is a little-known tax credit that could literally put up to $2,000 back in your pocket just for doing what you're already supposed to be doing, saving for retirement. You are not going to want to miss that one.
Thank you for watching Spousal Roth IRA. Double your tax-free wealth. If you found this helpful, don't just leave. Hit that subscribe button and turn on notifications so you never miss strategies that can change your financial future. And if you like this episode, give it a thumbs up. It really helps us bring you more content like this. See you in the next episode.